Good afternoon, everyone, and welcome to BDO's tax webinar for March. We've got quite a packed agenda, so let's get started on the next slide. You can see today's presenters and the agenda. So Jeff was meant to actually be chairing this, but he's having a bit of IT issues, technology these days. And then we got Marvin to speak about the VAT updates, and hopefully Jeff can join us by speaking about the tax direct updates. And then myself, I'll be speaking about the budget announcements. And also David Porter will be doing his presentation on corporations tax. It will be on post-insolvency key tax issues. So if you go on to the next slide, that's the agenda that I just spoke about. So hopefully Marvin can start us off with the VAT direct news.
HMRC has issued its first revenue and customs brief of the year, which relates to the VAT rate that should be applied to the live web streaming of a funeral, burial or cremation service. The technology in this area has developed rapidly, and it allows mourners who can't attend in person to view the proceedings in real time via live web streaming. There is an exemption in the VAT Act for services in relation to the disposal of the remains of the dead and the making of arrangements for or in connection with the disposal of the remains of the dead. However, the provision of goods and services not directly connected with the making of such arrangements, such as the provision of flowers and headstones, does not fall within the exemption and is a separate VATable supply. HMRC has clarified in the brief that in their view the live streaming services fall within the VAT exemption when they are provided by an undertaker, a cemetery operator or a crematorium operator. This means that any VAT incurred by an undertaker, cemetery or crematorium operator on the cost and overhead of providing such a supply of web streaming is not normally recoverable because it's directly attributable to an exempt supply. However, the brief also confirms that live web streaming of services supplied by a third party for a separate consideration is not within the scope of this exemption and will be subject to VAT at the standard rate as normal. HMRC is advising that if VAT has been previously charged or reclaimed incorrectly, then an adjustment should be made, and this will be subject to the usual 4-year period and the usual disclosure thresholds. So if you have any clients in this area, it'd be worthwhile checking whether they have accounted for VAT in error, where this has resulted in overcharging customers VAT and overclaiming input tax, because it may be necessary for them to make the necessary adjustments. The second point I'd like to mention is the Court of Appeal decision in the case of Northumbria Healthcare NHS Foundation Trust. The trust in this case provides pay and display car parking to hospital attendees, including patients, staff and contractors. The trust originally accounted for standard rated VAT on the car parking, but later submitted a claim for repayment of this VAT and HMRC refused the claim. The amount of VAT at stake is approximately £260,000 for this trust. However, we understand there are around 50 similar appeals by NHS bodies stayed behind this appeal, with a total tax at stake of around £70 million. The Trust argued that its supply of car parking does not constitute an economic activity, and as a non-business activity, it should be outside the scope of VAT. Alternatively, it should be VAT exempt as being closely related to the provision of medical services. HMRC took the view that the supplies should be VATable, as would be the case with the provision of car parking in the private sector. Both the first tier tribunal and the upper tribunal dismissed the trust appeal and held that the trust was carrying on an economic activity for VAT purposes as a taxable person, and those services were not closely related to exempt hospital and medical care. Therefore, they are subject to VAT. The Court of Appeal has now disagreed with both of the earlier decisions and held that because NHS organisations operate under a special legal regime under which they are required to make sure users can get access to the hospital site and park if necessary, as safely, conveniently and economically as possible, the NHS Trust in this case was carrying on a non-business activity that is not subject to VAT. As a consequence, the supplies of car parking by the Trust were not VATable and the Trust was entitled to its VAT reclaim. The Court of Appeal also concluded that HMRC had not demonstrated that non-taxation in this case would lead to a significant distortion of competition with the private sector. It should be noted that this is not a blanket decision that all NHS parking is non-business, and the position will be different, for example, where an NHS organisation chooses to subcontract its car parking activities, where any supplies made by a private subcontractor will be subject to VAT as normal, because the subcontractor wouldn't be making supplies as a body governed by public law under a special legal regime. Although those particular cases in quite a specific area, it does highlight that the status of an entity, in this case, the fact it was operating under public law, can change the VAT treatment of supply, so this is always something to be mindful of. Finally, I would like to mention amended guidance issued by HMRC on its website relating to late payment interest. The law was changed with effect from the 1st of January 2023 to allow HMRC to charge interest on late payments of VAT relating to amounts overdue following the submission of a VAT return, an amendment or correction of a return, a VAT assessment issued by HMRC, or a missed payment on account. The late payment interest is charged from the first day that the payment is overdue until the day it's paid in full and is calculated at the Bank of England base rate plus 2.5%. The amended guidance confirms that taxpayers can't appeal against the late payment interest charge, but can object to the imposition of interest. A taxpayer can object where either HMRC has made a mistake or caused an unreasonable delay, which has contributed to the build-up of interest. There's a dispute over the effective date of the relevant payment, so when the payment is actually due, or the taxpayer is questioning the legislation under which the relevant payment is due. HMRC says that they can only accept an interest objection if a taxpayer has fully paid the tax for which the interest charge has been made. So, this new guidance may be useful to reduce or prevent an interest charge that has been automatically applied, depending on the reason for the late payment.
So I'll take over from here. This is just going to be a quick overview of the budget announcements which recently occurred. There's a lot to cover here because it was quite tax heavy, so I'm going to slide through the presentation. So next slide, please. So these are the taxes I will cover on the next slide. So first is corporation tax. So if you go on to the next slide. So this table just clearly shows that they didn't announce anything for corporation tax. The rates are going to be kept the same till 2030. So at least we get some consistency and we know what's going to happen in the future. So if you go on to the next slide. Okay, capital allowances. Now the government confirmed that full expensing, 100% first year capital allowance for expenditure on main pool and plant and machinery, and a 50% first year capital allowance for special rate allowances would be made permanent for companies subject to corporation tax. So it was announced that a working group would be formed to consider the extension of full expensing to assets for leasing, where the lessor is treated as the owner of the asset for capital allowance purposes. So plant and machinery provided for leasing is currently actually specifically excluded from qualifying first year allowances, and therefore full expensing, except for specific rules regarding leasing of background plant and machinery within the building. The Chancellor has now announced that draft legislation will be published shortly with the intention of extending full expensing to assets for leasing. However, start date's still not clear yet, and we'll see what the draft legislation says. Next slide, please. So there were some announcements for creative industry tax release. The Chancellor announced a range of tax measures to support the UK's creative sector. So the first one is about film and TV, so British film and TV. A new independent film tax credit will be introduced, effective for films commencing from April 2024. The credit will be 53% of qualifying expenditure incurred on films with budgets under 15 million. There's also tax relief been announced for theatres, orchestras, museums and galleries. So the previously announced higher tax rates reliefs for touring shows were to be phased down from 20% to 20 or 25% respectively by 2026, 27. The Chancellor confirmed that these will remain at 40% and 45% tax relief on a permanent basis to support theatres and orchestras, museums and galleries. So if we go on to the next slide, there'll be more tax incentives, this time for investment zones. So since the 2023 autumn statement, you might have heard that the government has been working with local authorities to devise further plans around how local growth and investment will be driven in each investment zone. So further announcements have been made about 6 of the 12 planned investment zones. So these are in Manchester, Liverpool, North East of England, South Yorkshire, West Midlands and West Yorkshire. And further announcements are expected to be made for investment zones in Tees Valley and East Midlands. So if you go on to the next slide. COVID recovery loans. So these have actually now been there's been a name change. They're now called Growth Guaranteed Schemes, and it will be extended till the end of March 2026. If you remember, what the recovery loan schemes do is they offer a 70% government guarantee on loans to SMEs of up to 2 million in Great Britain and 1 million in Northern Ireland. So they're going to be extended till the end of March 2026. So if you go on to the next slide, there's some employment tax changes. So if you go on to the next slide. Now here's what was one of the biggest announcements, and it was widely expected that Chancellor would cut national insurance contributions, and that's exactly what he did. So he made some changes to Class 1 and Class 4. So Class 1 is for the employed. Class 1 NICs, just a reminder, they apply from an annual threshold of 12,570 to an annual higher threshold of 50,270. That between those thresholds, the rate is 10% currently. It was reduced from 12% in the autumn statement with effect from 6 January. So now it's been further reduced by 2%. So from 6 April 2024, the main rate will drop from 10% to 8%, so a 2% drop. That works out at a saving of £754 per tax year, a maximum saving. So that's really helpful for all workers. Remember, employers also pay NICs, but and that currently is at 13.8% on the lower threshold. That's not going to change. Don't forget self-employed people. They've also changes have also been announced for them. So Class 4 NIC is currently at a rate of 9%. The rate was due to reduce to 8% from 6 April 2024 this year. That was what was announced in the autumn statement. But further relief was announced in the budget. So instead of getting Class 4 NIC reduced to 8% from 9%, it will now be reduced a further 2% to 6%. So Class 4 NICs is going to go from 9% to 6% from 6 April 2024. So these are the huge savings going to be given to self-employed people and employed people. So good news for them. If you go into the next slide. It's just a quick thing to say about umbrella companies. So HMRC is aware that some of these umbrella companies aren't legitimate and are actually taking advantage and abusing some tax holes. So they're just going to target abuse for non-compliance in the umbrella sector. So following the recent consultation on tackling non-compliance, many were expecting actually a budget to be announced a budget announcement to be announced, but it actually didn't. Any action will now take place in the tax administration day, which is going to be on 18th April 2024. And they announced that new guidance will be published in summer 2024 to support workers and other businesses who use umbrella companies. Okay, so if you go on to the next slide, there should be some personal tax changes. The first of which is on the next slide, which we'll talk about non-DOMs. And this was a huge change. So at the moment, they're just proposals. So I think what we're going to do is we're going to have a separate session on this, specifically talking through the announcements, because you can have a 20-minute session on this easily. And it gets quite technical, but I'll just go through the main headlines. So the government has announced proposals to abolish the current tax treatment for UK resident non-DOM individuals from 6 April 2025. So from that 6 April 2025, the current remittance basis regime will actually be replaced by a new residence-based test. Now, the new regime will be available for 4 years, starting from 6 April 2025. It will be available to any individuals who have been non-UK resident for at least the previous 10 tax years. During these 4 years, new arrivals on the UK will not be subject to tax on their foreign income and gains, nor on distributions from non-resident trusts. These can be brought into the UK freely without attracting a tax charge. So that's a huge change. Those opting into the 4-year foreign income and gains regime will lose their entitlement to personal allowances and annual exempt amounts for CGT, just the same as the current rules are for if you claim the remittance basis. After the initial 4 years, individuals will be taxed on their worldwide income and gains in accordance with the normal tax rules for UK residents. So after the 4 years, there won't be this current regime about remittance basis. So this is a huge change, and it's going to affect a lot of non-resident individuals and non-DOMs. So if you go on to the next slide, this is just talking through that there's going to be some transitional provisions. So for current non-DOMs who move from the remittance basis to the arising basis on 6 April 2025 and do not qualify for the 4-year foreign income and gains regime, special rules will apply to them for 25-26. So they will only be taxed on 50% of their foreign income for that year. And from 26-27, foreign income will be taxed in the normal way. So for 25, 26, 27, there'll be a reduced rate, which will apply to remittances of pre-6 April 2025 personal foreign income gains. If you go into the next slide, it will talk about inheritance tax. Okay. There is an intention to move away from a domicile-based system to now a residence-based system for inheritance tax. And that's going to be from 6 April 2025. And there'll be a period of consultation ahead of this before they bring in the rules. So nothing has been confirmed yet, but it is envisaged that inheritance tax will be charged on individuals who have been UK resident for 10 years, with the intention to keep individuals within the scope of IHT for 10 years after leaving the UK. So as is the case now, UK cited assets will remain within the IHT scope. Non-UK trusts, which benefit from excluded property status, are currently expected to remain outside the scope of IHT. So that's another huge change, and that's going to affect a lot of trust arrangements for your clients. So like I said, there's a lot here, and there's a lot of technical changes. So I think what we'll do is we'll cover it off in a future session, a future much more detailed session. So if you go on to the next slide. This is just a summary of the changes. It tells you about the dates and the foreign income regime, and the IHT changes, which I just talked about. So it's a good summary to go back to. If you go on to the next slide. There was also some smaller changes, and now these are to do with property tax changes. So currently, as you're all aware, residential property gains are taxed at 18% for gains that fall within the basic rate band and 28% thereafter. The Chancellor announced that the higher rate will be reduced to 24% for property sales that exchange on or after 6 April 2024. Now remember, there's a 60-day reporting requirement that runs from completion to report all these gains on properties. So it will be important to be aware that property returns being submitted from 6 April 2024 may still be required to use that 20% rate if the sale exchange on or before 5th April 2024. Okay, if you go on to the next, oh yeah, just go on previous slide, sorry. There was also announcements about furnished holiday lettings. So as you're aware, the furnished holiday lettings regime had treated qualifying residential accommodation by way of short lettings as a deemed trade for certain tax purposes. And as a result, some businesses got a lot of tax reliefs. But it was announced in the budget that this regime will be abolished from 6 April 2025. This will mean that furnished holiday stations will be treated as a property investment business from that day onwards. And that means the associated tax benefits of being a trading business will go away. So if you go on to the next slide. And this is just about the high income benefit charge. So there was changes announced to this. So parents will receive child benefit at the following rates from April 2024, £25.60 a week for the eldest child and £16 for an additional child. Currently, if either partner is over 50,000, then the high income benefit charge applies to claw back the child benefit, such that it is fully repayable once your income is over 60,000. You are required to complete a self-assessment tax return, Okay, but the changes from 6 April 2024, the threshold will increase from 50,000 to 60,000. With an extended taper, so that child benefit will be fully repayable once your income is above 80,000 and not 60,000. So they've given the relief for individuals earning higher amounts of income. Okay, I think that's the end of my slides, and the next one's to do with VAT. So over to you, Marvin.
Yep. So there were a very quiet budget for VAT, as is usually the case. So the first point was around the VAT registration threshold, which has changed for the first time in 7 years. So to ease the burden on small businesses, the government's announced that it will increase the VAT registration threshold with effect from the 1st of April from £85,000 to £90,000, and the deregistration threshold will be increased from £83,000 to £88,000. And the government estimates that over 28,000 businesses will benefit from this change from no longer being VAT registered. So that's a welcome change for smaller businesses. So next slide, please. So the VAT retail export scheme, so this is relates to tax-free shopping, which was removed after the 31st of December 2020 as a consequence of Brexit. There's been lots of lobbying on this for the government to reintroduce tax-free shopping, and the government's received analysis by the Office for Budget Responsibility, and they said they will consider these findings alongside industry representations and broader data, but no changes are yet in the pipeline. But governments say they will continue to consider it, and it's hoped that it will be kind of brought back at some point in future. And the final slide, please, on VAT. This just relates to private hire vehicles. So there was a case in July last year, not a VAT case, but it related to Uber and whether they were acting as a acting as a principal in supplying taxi services or as an agent, and this can affect the VAT treatment. So if they're acting as principal, then VAT may be due on the full taxi fares. So the purpose of this consultation is to explore a range of options to discuss kind of the VAT treatment of the services provided by the likes of Uber. But it's probably going to be a long time, I think, before any conclusions are reached and before any changes are made. Yes, so the first point was around multiple dwellings relief. So in November 2021, HMRC issued a consultation regarding the SDLT treatment of mixed use acquisitions and also in respect to multiple dwellings relief. So mixed use, if an acquisition is of mixed use property, then the non-residential rates of SDLT should apply, which are a lot lower than the residential rates. And also multiple dwellings relief provides a beneficial rate of SDLT where more than one dwelling is acquired. So it can be very beneficial in respect to the acquisition of residential property. But because of this, there's been what HMRC perceived to be abuse of the rules. So effectively, people claiming multiple dwellings relief where they consider it's not applicable, and also people trying to suggest that land is of mixed use to fall within the lower rates of SDLT, which again HMRC perceived to be unacceptable. And there've been a large number of tribunal cases on this. Could be like one every couple of weeks that we're seeing at the moment. So it's been taking a lot of time up for HMRC, lots of litigation going through the courts. And so they issued this consultation in November 21, and they suggested a number of amendments. For example, they suggested doing some kind of apportionment where there's a mixed use acquisition. So you pay the higher residential rates on the residential part of the acquisition and the non-resi rates on the commercial part. We hadn't heard anything further from that consultation, but now, as part of the budget, the government have announced that multiple dwellings relief will be removed entirely with effect from the 1st of June 2024, which has come a bit of a surprise that they've removed it completely, but that's the position now. Any contracts exchanged before 6th of March will be grandfathered, so you can still claim multiple dwellings relief in respect of those. They've also announced that there'll be no changes regarding the mixed use acquisitions. So this is quite surprising because we considered it should be relatively straightforward to amend the legislation in this area, but they've confirmed that there'll be no changes in relation to mixed use acquisitions. So if there is a genuine mixed use of a property, for instance, a farm where there's a dwelling with a commercial activity being undertaken on the farm, then the mixed use rules should apply, and therefore the non-residential rates of SDLT should be applicable. The second point is around public bodies. So this just ensures that the penal 15% SDLT rate that applies to certain acquisitions of residential property won't apply to public bodies in a way that it wasn't intended to. The relief for registered providers of social housing. So this is a relief that's available to certain bodies where they use grants that have been obtained under certain legislation. This is being updated to ensure that the relevant grants that are being obtained fall within the relief, because the relief lists the legislation that's applicable. So that's going to be extended to include other grants that these bodies are able to obtain. And the final point is just a change on the first-time buyers relief, to some tweaks to those rules to ensure that they apply in a fair way. Okay, next slide, please.
Looks like no questions so far. So if we go on to the next slide. And over to David Porter to talk about post-insolvency key tax issues.
Hello, everybody. So this is a slight change of tack, very different issue here. And I'm only going to be able to give a broad flavour of the subject in the 20 minutes that I've got. So next slide, please. The agenda I'd like to cover, though, is just to go through very quickly types of insolvency process, tax in insolvency, and what makes it different from the normal situations that we deal with day to day. What are the typical tax issues in an insolvency? And then tax grouping, looking at the impact of insolvencies on the preservation of tax groups. Then we'll look at specific issues for liquidations, dealing separately with solvent and insolvent liquidations, and then administrations. And in particular, one type of administration, which is called a pre-pack administration. And finally, we'll finish off with voluntary arrangements. Next slide, please. So just to start on the types of insolvency process, this slide summarizes the main types that we're likely to come across. First one is administration. So this is typically part of the rescue culture. This is designed not just to close down a business, but to rescue it. And that will quite often take the form of a pre-packaged sale of the business as a going concern to a purchaser. That sale might leave the company insolvent, but nonetheless the business has been rescued, and it's more easily done within an insolvency process. The second type that will come across is liquidations. Very common, different types here. And I'll use acronyms during the presentation, so it's helpful if you remember these. First one is creditors' voluntary liquidation. So that's when a company is insolvent and the directors want to voluntarily wind it up. That's a CVL. A compulsory liquidation, or WUC, that's where the court will compulsorily wind up a company because of insolvency or other reasons. And the third type is a solvent liquidation, where the directors voluntarily want to end the company's life and distribute its assets. And that's an MVL, members voluntary liquidation. Third type is a receivership. You don't see a lot of these, except in relation to enforcement over property. That tends to be where you'll see it a lot. So real estate finance will very often be, lenders will enforce by way of receivership, and they are known as LPA receiverships or fixed charge receiverships. subtly different but broadly similar tax consequences. And the final one is a lighter touch process, which is just short of insolvency, but designed to give a business breathing space, and that's the company voluntary arrangement. Or its more modern version is a restructuring plan. And you'll have seen a lot of these in the press involving retailers getting relief from their landlords. Next slide, please. So having sort of set the scene in terms of different types of insolvency process, I thought it would be helpful just to kind of show at a glance what sort of things are different for tax in an insolvency process. And the first thing is there's no longer any accruals-based accounting. So the structure, the financial structure that we're all used to, building our tax comps off of accruals-based accounts, no longer exists. What we have instead is receipts and payments accounts, where everything is included by the insolvency practitioner on a cash basis. And you need to convert that into a sensible tax computation. And sometimes that tax computation will involve elements of accruals basis and sometimes elements of realization basis. And you need to be relatively pragmatic in terms of how you sort of put this together, but it needs to be consistent, applied consistently and fairly. So to get this through the revenue, they will want to see that the filing's been done on a consistent basis on both the receipts and the payment side. So specific examples of that, you'll probably see if pre-appointment debtors are collected, then that shouldn't be a taxable receipt because it's the receipt of a realization against a pre-existing balance sheet asset. So had you drawn up accruals-based accounts, you wouldn't have taxed that. And that's fine. Equally, you shouldn't be deducting payments of pre-appointment liabilities. Less likely that will happen. Typically, the payments will relate to post-appointment costs that the insolvency practitioner will have to incur. And so on both an accruals basis, an account and a cash basis, that should be deductible. Although there might be debate about which period it should be deducted in. The next point to make is you'll typically have a lack of financial information. So you're often working in something of a vacuum. You won't have had any statutory accounts probably for a couple of years, no tax comps for a couple of years. You'll have management accounts, hopefully, in the cleaner cases. And you'll have to work with the information that you've got to come up with the most reasonable and appropriate tax computation going forward. Now, insolvency practitioners won't typically file corporation tax computations for pre-appointment periods. And if they do, it'll only be because there's some potential benefit to the creditors in doing that. So, for example, if there was a tax refund which could be recovered, then they might incur the costs of preparing those computations. But an insolvency practitioner wouldn't normally sign such a computation because they can't take responsibility for something that's been done by the directors prior to their appointment. Another problem, practical problem we face is that HMRC processes in insolvencies are fairly haphazard, and it can be difficult to get them to focus on problem cases. So, for example, the under-resourcing, of course, of the revenue means that insolvency is not a high priority, except for the debt management unit, of course, who are prioritised to collect as much cash in as they can on the time to pay agreements. So the other stuff that the insolvency practitioner might want support from the revenue on, we tend not to get. In recent weeks, they have removed the ability to get a tax clearance, for example, at the end of an insolvency process. And that used to give a lot of comfort to, certainly on solvent liquidations, that if the revenue gave clearance, that you could make a final distribution and close the company finally. that they weren't then going to come up with a challenge later. Now that they won't give that clearance, I think we'll find insolvency practitioners more cautious about accepting appointments in the first place and wanting reassurance about the tax, the sort of the tax due diligence position of the company prior to them getting involved, because they won't be able to get out of office until they're satisfied that that everything's been dealt with to the revenue satisfaction, and now they won't be able to get the revenue to sign off on that. So that's quite an important practical change, I think, to how we handle the tax filings. Another area that is important to understand is that there's a statutory waterfall in terms of which order people get paid, creditors get paid off in. And tax comes at different places within that waterfall, and it may make a difference as to how much work we do to settle any tax matters. So, for example, if all the realizations are fixed charge proceeds, then the creditors will be the fixed charge creditor may be paid out in full, with no proceeds left over for anything else behind it. So the revenue will never get any, be able to collect any tax to the extent that the fixed charge holder is going to collect in priority. So in those sorts of cases, we might do a bit less work than in cases where it does actually make a difference. There was change about 3 years ago where the revenue were promoted in terms of their priority to second preference status, and that was only certain types of tax, but importantly it covered VAT and PAYE. So for those taxes in the revenue are ranked higher typically in terms of pre-appointment tax rights compared with corporation tax, where they're just an unsecured creditor and therefore perhaps have less likelihood of collecting. Any tax that arises during the insolvency process, obviously the insolvency practitioner needs to file the usual tax returns, meet the statutory obligations to do so, and any tax will be paid as an expense of the process, which is fairly high up the waterfall, but again is still behind fixed charge creditors. So, I've worked on some insolvencies where because there isn't enough realizations to cover even the fixed charge creditors, there's very little incentive to deal with tax in a particularly rigorous manner, because the revenue are never going to recover anything anyway. But nonetheless, the important thing is the insolvency practitioner needs to meet their statutory obligations. So still need to do a professional filing, but the detail of that might be less than where there's some real cash tax at stake. It's worth understanding Crown set-off, which is relevant to a lot of these cases. So that means that the revenue entitled to set off any tax refunds for corporation tax, for example, against liabilities and arrears for VAT and PAYE. So all these taxes get lumped together, and you only get a net refund if there's a debtor overall. You can't recover corporation tax when you're still owing VAT and PAYE. And that rule doesn't operate across the relevant dates. So it doesn't stop you recovering post-appointment input VAT just because you've got pre-appointment liabilities. So it only operates, pre-appointment. Any pre-appointment tax liabilities get aggregated. Any post-appointment tax liabilities get aggregated. But they're dealt with separately. The two sides are dealt with separately. So that might be relevant when you come to looking at some of the tax refund opportunities that I'll talk about in a minute. The next slide, please. So what are the tax issues, typical tax issues in insolvency? Well, there are tax exemptions to cover debt reductions and reliefs. That will typically be to facilitate restructuring within groups where there are some insolvent companies and some solvent companies, and you want to avoid paying tax on credits where you're relieving a liability for a company. You want to minimize tax leakage on realizations, and not just on the realizing of the asset, but also the distribution of that money to creditors. One of the most high-profile insolvencies of the last few years, the Lehman's case, threw up some rather interesting example because it, unusually for an insolvency, produced a big surplus. So all the creditors were entitled to a payment of 8% statutory interest on top of that. And it went through the courts to decide whether withholding tax should be applied to the interest or not. And finally, it was decided that it was actually annual interest, this 8% statutory interest, and therefore withholding tax did apply, which of course had a huge impact because a lot of hedge funds had bought the debt, and therefore they would be suffering. Many of them would be suffering withholding tax on it. So the tax planning is to minimize the tax leakage on the realization and to ensure as much of it as possible gets into the hands of creditors. You'll want to try and optimize any potential tax refunds. So input VAT can be recovered on a Form 427 post-appointments, the special procedures for insolvency companies. TLR, that's terminal loss relief. So if you've got a trading company that's paid corporation tax in the last 4 years before appointment, and quite often these companies turn around very quickly. So you might have a loss in the last 12 months, which you can carry back to get refunds of corporation tax previously paid. Obviously, before you do all that work, you need to check the Crown set-off position and make sure you're not just going to lose all of the potential refund against VAT and PAYE arrears. But even then, it may be worth doing that, because if you can degrade the amount that the revenue is claiming as a preferential creditor, then you'll leave more money available to the unsecured creditors. So it still may be worth doing that. And finally, the R&D refund, a cash refund, that's only available if you're a going concern at the time you make the claim. And obviously, if you don't get the payout in time before you go into an insolvency process, you might get caught up in Crown set-off again, so you might never get the refund. So you'll often find that insolvencies tend to be timed. R&D is sometimes a factor behind which impacts on the timing of going into insolvency processes. If the company's got any tax attributes, then the administrator is going to be looking to get value for those. So bear in mind, if within a group, you might previously not have paid for group relief, but once a company goes into insolvency process, then you should be looking to, if you've got losses, you should be looking to sell your losses to other group companies. You no longer take a group-wide view of it, and the administrator is acting solely in the interests of the company, the one company it acts over. Obviously, if it acts for the whole group, every company is insolvent, then that's a different matter. But if you've got companies inside and outside of processes, then you have to maximize the benefit for your company. And then importantly, you have to think about the impact on tax groupings of companies going into insolvency. So the next slide will now cover that. So there's two aspects to consider here. First of all is the control. The shareholder control might be impacted by a company going into an insolvency process. And secondly, the beneficial ownership of its assets might be impacted. So there's a possible impact both upstream and downstream. And that's what this slide is designed to illustrate. If we look on the sort of right-hand side of the diagram, you've got PLC owns Company B, which has gone into liquidation, and Company B owns Y, which isn't in an insolvency process. So what happens there is company B is deemed to have lost beneficial ownership of its shares in Y. So there's a loss of beneficial ownership downstream, which means that B can't surrender losses to Y anymore. And meanwhile, the arrangements provision in section 154 means that the shareholders of PLC can no longer control the company B. So you lose the grouping upstream as well, and X can't surrender losses to B or vice versa. The Farnborough Airport Properties case concerned a receivership, but a receivership over the whole of the assets of a particular company. So it is analogous. The decision in that is relevant to administrations and liquidations, despite it being a receivership case, and that sort of confirmed what I've just described here. For CGT group purposes, there's a special provision which means that you don't lose a tax group simply because of a company going into liquidation. So that's a special rule which protects the CGT grouping. Returning to the diagram here, the purpose of showing this as well is to illustrate, in this case, there's a debt, a 50 million debt owed by company Y to company X. And the question is, if you waive that debt, is it tax-free? Now, normally you'd say, well, a PLC is a company which controls both X and Y, and therefore they're connected companies, and the waiver will be tax-free. But in this case, that's no longer true, because PLC is not able to control X and Y. So a waiver would be taxable in this scenario. So be careful where you've got groups which have got some insolvent companies and some solvent companies. Don't just assume that you can waive and treat them all as connected still. There are also secondary tax liabilities to consider. So back to the capital gains point, if an insolvent company realizes a gain and doesn't pay the tax, then that can sometimes be collected from other group companies. And in particular, it can be connected from the principal company of the group. So in this case, PLC would be liable for tax which wasn't paid by ALB, or it can be collected from any other company which previously owned the asset in the group. So it's a nasty little sting sometimes if you've got opco-propco structures where you've moved assets around to create that structure, then you might be caught out by this in one or other of those companies. Next slide, please. Just very quickly, this slide was designed, this summarizes what I've just said about liquidations, and in particular insolvent liquidations. If I just focus you on the table on the left there, that's designed to show that the rules, the impacts of these of insolvency on the various different tax provisions, whether it's group relief, capital gains grouping, stamp duty grouping, VAT grouping, loan relationship connection, loss allowance, carry forward loss allowance, that is. The answer is different for each of those, because they all have their slightly different definition of control. And it can differ upstream and downstream. So I've just used that to illustrate that you have to look at each one individually and consider it on the facts. Next slide, please. So far, we've been talking just about insolvent cases. Here we're just looking at the solvent liquidation. Three pitfalls I've highlighted on this slide. First of all, there are two levels of capital gains tax to consider, both at the corporate level, when Y distributes its assets to the shareholder, then that's a disposal by Y of its shares in Z. Might be covered by SSE, might not be, but it's a capital gains disposal. And then at shareholder level, on that distribution, an individual is deemed to have received a capital distribution under Section 122. So there are two levels of capital gain to be considered in that scenario. You also have to think about, normally you're expecting to get a capital gains tax rate, which is typically lower at 10% or 20% relative to dividend treatment at near 40%. But there's anti-avoidance rules. The transaction securities rules can be used to target situations where you've got a money box company, for example, down the bottom. Instead of paying dividends out of it, you liquidate. And the Phoenix TAR, the anti-Phoenixism TAR, that's targeting where an individual gets money on a liquidation, a solvent liquidation, and then reinvests or starts a similar business in the next 2 years. So either of those rules can catch you out and force you, to pay the higher tax rate, i.e. a capital into income recharacterization. And finally, a distribution in specie, which is what the liquidator will typically do if it's got any non-cash assets left, often benefits from, there's no stamp duty or no SDLT typically if there's no consideration given. But watch out for the scenario where you've got where Y owns a property and you're distributing that in specie subject to a mortgage, then the liability may be seen as consideration for the distribution. So you then have SDLT on the recipient of the distribution. Next slide, please. I think I'm running out of time, so just speeding up. Administration is, as we discussed, more of a rescue procedure. There are special rules. Again, it's got the tax degrouping issue upstream, less likely to degroup downstream because a company administration doesn't lose beneficial ownership of its assets. That's only true of a liquidation. There's case law on that. So normally it's considered that a company administration keeps the beneficial ownership and keeps the grouping downstream. Not without argument, though, that point. That does actually lead to some quite bizarre scenarios. So in this one, I've illustrated one where if company Y and company Z both went into administration, it appears that Y can surrender losses to Z and vice versa still. And that's because there's no person who can control Y or Y but not Z or vice versa. Because there's a loss of control of both entities, it seems that the arrangements provisions don't stop you providing group relief. So that's counterintuitive, but it seems to be what the rules say. Next slide, please. Pre-pack administration is the one I mentioned at the start, which you'll very commonly see where a disposal is done on day one. Everything's sort of pre-arranged. The marketing of the business is done before appointment. The directors are working with a potential administrator, and then the administrator comes in and undertakes the transaction on day one of the administration. There's a nasty pitfall here in that you've potentially got a 1-day tax accounting period, because administration itself ends an accounting period. But then if you're a trading company and you stop trading at the end of day one, then you've got a 1-day accounting period. If you've got tax on goodwill or a capital gain or on an IFA, that's falling in a 1-day accounting period may be difficult to shelter. I mean, you might have a huge bank of losses brought forward, but you could only use a fraction of those losses, 5 million attributed to a 1-day accounting period. Now, an administration doesn't give a special relief for it. In liquidation, there can be a relief, but not in administration. So losses may not be available to shelter it. So you're going to have to look carefully at other things like capital allowances and stock and debts. But all of that needs planning before the company goes into administration. Otherwise, you'll end up in a quite nasty situation where it's all been done and you can't do anything about it. Next slide, please. Which I think is the last one. So yeah, company voluntary arrangements. We talked briefly about this at the start. This is light touch restructuring. You don't lose control. There's no lot of degrouping risk here. There's no loss of control. You don't actually go into an insolvency process. And there are tax reliefs available, so that any debt release exemptions, if there's a debt reduction, that won't be taxed. Any clawback of input VAT due to the cram down of creditors, that doesn't happen, provided that the debt's less than 6 months old at the date at the start of the CVA. You don't lose any R&D cash credits because you're still a going concern. So it's quite an attractive way of getting breathing space. Now, in the case of the retail community and the deals with the landlords, what a retailer will typically end up with is a big P&L credit for the post-restructuring. And a lot of that may be attributable to an onerous lease, the release of the onerous lease provision. And it might be a mixture of historic rents being crammed down, but also a reduction in future rents. So that's often reflected through a release of the onerous lease provision. Now, until recently, there was a big problem because you might have claimed relief for that onerous lease provision before the CVA, but when it was released, you were limited on the use of losses to 5 million plus 50%. They have now brought relief in to enable you to expand your 5 million allowance for any previous onerous lease provision. So they've made special provision to expand the 5 million there to avoid problems for companies in CVA. And the final point, yes, CVA, the costs of a CVA, not quite often fairly substantial. It's important, I think, to take account of what the costs were incurred in respect of, and if you're treating the debts as exempt, a release of debt as exempt, then perhaps you should be disallowing some of the CVA costs. But a reasonable apportionment between taxable and non-taxable items would normally be my recommended approach. Okay, back to you, Sadiq.
Thanks, David. That was very helpful. No questions have come up yet, so if you do have any questions, please just do send us an email and David can follow up on that. But as we're coming to 3 o'clock, and I'm going to shortly resolve this session. And sorry for the apologies for the sound problems earlier. Jeff can do a separate session on that next session, probably next month. Just a reminder that we've got the annual conference in June the 12th or June 13th. Please do register your interest and let us know if you want to attend. Thanks all, and hope you have a good afternoon.